Which mining stocks will perform best in the current economic environment? My guest today, Jordan from Mining Stock Monkey, brings his top picks in the mining sector and explains why he sees massive value in all of them up ahead, along with breaking down his overall views on the gold and silver space, the general economy, and why he thinks a debt crisis could be brewing in the government bond market. Let's dive into it. Jordan, it is great to have you back on Commodity Culture. Now, you mentioned last time you were on the show that silver scared you due to how far and fast it had moved, and you were also cautious on gold, noting the length of the current cycle compared to previous bull markets. Do you still maintain this view? And what would it take for you to feel like it's game on again for precious metals?
Yes, I do maintain that view, but it's all about time horizon. So maybe I can give a little bit more nuance this time. And if you compare this gold bull market compared to previous gold bull markets since the US government took away the $35 price fix, there's been a bull market of 9 years, a bull market of 3 years, another bull market of 10 years. So this one, based on how I look at the charts, this one started in late 2015 when gold bottomed out there at around $1,050 or $1,050 per ounce. So 10 and a half years into it, it's looking pretty mature. But I mean, you take a bigger step out, and over the last 100 years or so, the dollar has lost 97% of its value. And I see there's no end in sight there. So perhaps over the next 100 years, the dollar loses another 97% of its remaining value. And as the dollar trends towards zero, the theoretical limit of where gold or any other hard asset can be is literally infinite if you're pricing it in dollars. So yes, I do think this gold bull market looks mature, but also, on the other hand, I wouldn't be surprised at all to see $50,000 or $100,000 gold in my lifetime because of the devaluation of the dollar. Now, what that $50,000 or $100,000 will buy you in today's world, well, I mean, that's a totally other question, and probably not nearly what it buys you today. But I think overall, in general, gold preserves its purchasing power. And what else? So I see that over the longer term that it's probably going much, much higher. But considering this 10 and a half year bull run we've been in, I also wouldn't be surprised at all to see several years of sideways movement, consolidation, maybe down a bit. And it also wouldn't surprise me at all to see a quick run to $10,000 with a blow off top like we had back in late 1979 and into January 1980. So that's just an overall way to say, Jesse, I have no earthly idea where gold is going to go next. But I would like to say that where I've made the real money in my life is not trying to predict where a commodity goes next. Where I've made the real money is finding a company where I see a major upcoming catalyst or a series of upcoming catalysts. And if those catalysts play out how I think they will, the risk reward there is very promising. And it's all about risk reward when I'm looking at these things. Like, how much potential upside is there and how much potential downside is there, and what's the likelihood of each scenario? And when I see a really asymmetric bet towards the upside, I bet big. And that's where I've made most of the money in my life, not trying to predict what gold will do over the next few months or what silver will do. And I answered that question based on gold, but gold and silver kind of trade in lockstep. So you can basically apply that to silver too.
Yeah, some great thoughts there. Are you of the same mind when it comes to gold and silver mining stocks? Because at these levels, the producers are reporting massive earnings, and yet the market reaction has been largely muted and even somewhat bearish in the aftermath of record earnings by these big companies such as Agnico Eagle and Newmont. Why do you think that disconnect exists, and what are your overall thoughts on gold and silver miners here?
Yeah, sure. So if you look at Agnico, it's trading at about 16x forward free cash flow. Look at Newmont, about 12x forward free cash flow. And that's 10 years into a bull market at a fairly high commodity price. So if you're looking at that as an investor, like it's going to buying Newmont, gold prices have to stay at this level for 12 years, or they have to maintain this profit level for 12 years for me to essentially make my money back. Is if thinking as if you're buying the whole company. That's where this thinking is coming from, right? 12 years of free cash flow to get my money back. Now, what are the chances gold stays at these levels for another 12 years? I mean, I think it's pretty likely that within the next 12 years, we see lower prices at some point, and potentially much lower prices. Now, yes, these companies are posting record numbers, as they should with this gold price. But like Newmont, for example, they came out and great headline numbers, outstanding cash flow and earnings, and a really good AISC if you include the credits they get from, for example, silver and copper, close to $1,000 AISC. Without those credits, it's more like 1,700, but that's another topic. Now, but they said management came out and they said, "Hey, we see higher costs going forward," and market really doesn't like to hear that higher costs are coming. So I think that helped to mute the reaction to those blowout earning numbers. Now, when I talked about risk reward in my last answer, and when I look at the risk reward of something like Newmont or Agnico Eagle here, if the gold price goes up $2,000 an ounce, like the bull run keeps continuing, we go from $4,500 to $6,500. As an investor in those companies, you're probably going to get about a double. You'll probably double your money. But if you look at it the other way, and if the gold price goes down $2,000 and falls from $4,500 to $2,500, you're probably looking at least a 70% drop in the share prices of those companies. And because margins would collapse. So not just the price that they're selling their product for, the price of gold collapses, their margins collapse even further than that. And plus, the sentiment will probably turn from bullish to largely bearish in a situation like that, which would probably compress the multiples they get. So right now, Newmont's getting 12x free cash flow or future free cash flow multiple. Maybe it compresses to 10x. Plus those margins getting squeezed. So I think that results in at least a 70% drop in the share price. And now weighing a potential double against a potential 70% drop in the share price, I don't like that risk reward at this point in time in the bull market. And if you lose 70% on a stock, it doesn't take 70% gain to get back to where you started. It takes a 233% gain to get back to where you started. And those gains are tough to get. So that's why a lot of times, well, my investing philosophy focuses on managing my downside risk first, because if I do, the upside takes care of itself.
Great answer. Now, last time you were on, you also gave a really epic breakdown of risks in the global economy. And now we're seeing government bond yields at alarming levels. Have you been watching this? Do you think there's a risk of a crisis in sovereign debt markets? And if so, how could that affect financial markets in general, in your view?
I do think there's a pretty big risk. And to be fair, I've thought that for quite a while. But I think that risk is growing every month that passes. If I can, let me roll in my whiteboard to help illustrate something better.
Yeah.
Okay, so this is going to be a representation of the U.S. government. So this is going to be SAM. But instead of talking in the trillions of dollars, like I would have to if talking about the U.S. government, I'm going to break this down as if this is one person's budget. Okay, so Sam, he brings in $55,000 a year. that represents the US government's $5.5 trillion of revenue, $55,000 a year in income. But Sam spends $70,000 a year. Actually, it's 71,000. So that leaves Sam with an annual deficit of $16,000. Every year he spends $16,000 more than he makes. And every year the balance on his American Express card increases. So right now, as of May 2026, his balance on his Amex is $400,000. So he makes $55,000 a year, but he spends more than he makes, and he owes American Express $400,000 plus interest. But that's not all, because Sam has also been receiving weekly payments from his parents and grandparents for years. And Sam promised his parents and grandparents that he would fund their retirement if they gave him those small weekly payments. So Sam's obligation, the net present value of his obligation to his parents and grandparents, who are depending on this money in retirement, is $1 million. So that's parents' retirement. So if you break down the U.S. national debt and unfunded liabilities here into a household budget, you have somebody who's making $55,000 a year, who spends $71,000 a year, who owes $400,000 to Amex, and who owes $1 million to fund people's retirement. Okay? So Sam realizes, hey, I can't pay the interest on my debt unless I borrow more money. Sam's insolvent, so Sam has to borrow more money. So Sam calls up Amex and says, hey, Amex, I need to borrow more money from you so I can pay the interest that I owe you on the debt that I have with you. And Amex says, well, let's look at your personal balance sheet here and look at your income statement. Okay, so you earn $55,000 a year, you spend $71,000 a year, and you have $1.4 million in debt. Now, Sam, for me to even consider lending more money to you, I need to know how you plan to reduce your expenditures, because you need to be able to service this debt with your income. And right now you're just spending way too much money. And Sam says, you know what, that's ridiculous. This is just how things work. We always spend this much money. In fact, my old friend Massey, I didn't realize how much of an idiot this guy was, but he wanted me to spend less money. So I got rid of him as a friend, and I replaced him with some better friends who actually understand the value of spending money. And Amex is going to say to Sam, there's no way that we can lend you more money. In fact, we're going to slash all of your credit lines until you can start paying us back and prove to us that you can be responsible with your debt. And then Sam says, fine, Amex, I'll just go ask Visa for the money. So this is what the U.S. government has been doing for years. They've been paying their Amex with their Visa card, or even paying their Amex with their Amex and continuing to fund their budget like this. So when you're loaning money to somebody like this, there is huge risk here. And savers, investors, even institutions view loaning money to Sam as risk-free. Risk-free. What? Sam's insolvent. And you think it's risk-free? And you're holding billions and billions of dollars on your company's balance sheet in Sam's debt? Now, yes, Sam has managed to pay his Amex bill with his Amex for decades, or pay his Amex bill with his Visa for decades. But that works until the day it doesn't. Because one day the US government may decide, hey, right now we're spending 25% of our annual revenue on interest? We can't do this anymore. Screw these bondholders. Well, let's tell them we're not going to pay them, or at least have a major restructuring instead of defaulting all at once. Maybe we have a restructuring where we say, hey, we'll pay you 30 cents on the dollar. You owned a $10,000 bond. Now it's like you own a $3,000 bond, and be happy we're going to pay you that because, well, we just can't afford it anymore. Now, when I make this argument, somebody would probably say, but Jordan, you just don't get it. You don't get it because the government can print money. So this household budget that you have here, it doesn't matter because they can print their way out of it. They can just create new money and then pay off their old debtors with that. Now, yes, they've been able to do that. But at what point do these bondholders say, we're not going to buy any more bonds, or we're going to demand a much higher interest rate to buy the bonds because we either don't think we're going to get paid back or don't think we're going to get paid back in dollars that are as valuable as they are today? One of those two things. So I think that's why you're seeing interest rates increase, because these are Sam's lenders saying, hey, we demand a higher interest rate because you're insolvent. So whether it's an honest default and they say, hey, the government says, hey, we can't pay you all that we owe you and you're going to get 30 cents on the dollar, or whether it's a dishonest default and they just default through inflation where the money that the bondholders receive is worth less than it was, either one is a default. Now, if you're loaning the U.S. government money at 5% a year, and the stuff you buy goes up by 10% a year, you're not getting 5%. You're losing the difference. You're losing 5% a year. So, all that's to say is breaking that down into a household budget. I think there's major risk in the sovereign debt market. Maybe it's not an outright default or a major restructuring. Maybe it's just default through inflation. But I think either way, it ends in default because Uncle Sam is insolvent.
Yeah, and some great points there. I mean, if I was going to park capital with the US government for 30 years, I would certainly need more than 5% return on that. And I think that's a big part of the point you're making. Now, I'm wondering how your current view on the war in Iran kind of affects your investment outlook at present. Obviously, the closure of the Strait of Hormuz has already had a massive impact on energy prices. How do you see it potentially impacting financial markets, the global economy, precious metals, commodities, the broad market, assuming that it continues to drag on for longer than many are expecting?
Yeah, the Strait of Hormuz closure is a major issue, and it's already, I think, dragged on longer than many were expecting. And the International Energy Agency has said this is the biggest disruption of oil supply or energy supply in the history of oil markets. So, if this goes on and reserves around the world dwindle even more than they already have, and they trend towards zero, those countries, they have to become buyers of energy. And people are pretty price inelastic with energy because in our modern world, energy is life. Energy is what it takes to survive. So people will pay just about any price they have to for energy. So, I mean, we could see oil prices bid way, way up. I mean, if this drags on through, let's say through the end of summer for 3 or 6 more months, I would not be surprised to see $200 oil. Now what would that do? Or even an extended period of $100 oil. Oil and energy is an input to everything. Even if you're not buying gas directly at the pump, it applies to everything. You go into Target and you buy some green beans. You go into Walmart and you buy a kid's toy. Energy goes into everything, not just transporting it, but if it's food, farming it, all the farming equipment to get that there. And to transport everything everywhere. So when the cost of an input to everything shoots way up, that puts a lot of pressure on businesses, on the consumer. So, I mean, I think that has potential for a worldwide recession, to be the trigger of a worldwide recession. And in terms of the war, I mean, as I talked about in my last answer, the US government is insolvent, and they have to fund this war. So how do they fund it? They fund it through inflation. They fund it by printing more money, which is very inflationary for gold, silver, any other commodity, any other hard asset. So, I mean, the more inflation there is, the more you're going to see the stock market go up, the more you're going to see commodities go up, the more you're going to see house prices go up, all else equal.
Let's dive into some specific stock ideas now. And I want to talk about an idea you've been discussing on your channel. You've done some in-depth coverage on Hercules Metals. They put out some news this morning, and the market is sorry, I'll do that one again. Let's dive into some specific stocks now. And I want to talk about one you've been doing some in-depth coverage of on your channel. That's Hercules Metals. They put out some news this morning, and the market is way up on these assay results. Do you have any opinion on that drill hole and what it might mean for the company?
Yeah, Hercules is an interesting company. They had a brand new copper discovery back in late 2023, where they discovered a new copper district that people didn't know existed. And it created a big staking rush with Rio Tinto coming in and staking ground, with Barrick coming in and staking a ground. Barrick ended up taking a pretty significant stake in Hercules as well. And you've seen lots of big names and the big copper producers investing into the area. And Hercules was previously drilling out what they were calling their Leviathan deposit. And depending on the cutoff grade used, you're probably looking at between 300 to 800 million tons of copper there at Leviathan that they found so far, and that continues to be expanded. They haven't put it out an official mineral resource estimate, but that's something they're working on this year. The importance of this drill hole from today is that they confirmed a new porphyry discovery a few kilometers south of Leviathan. Now, these aren't grades that are going to work, at least not from this drill hole, because the copper that was intersected was at something like 900 meters downhole. So this is way too deep for an open pit. This would have to be a block cave, and it was only a little over 0.5% copper or so. So they have to find higher grades for this to work as a block cave, but it confirms that there's more porphyries on their land. And we thought there were going to be more porphyries there because they have these geophysics. They did some IP surveys, they did an MT survey, and these geophysics are overlapping with the existing mineralization they've already found. And it's illuminating some other areas on their property that look to be other porphyries. And this drill hole confirmed that it was another porphyry. But I mean, they're going to try to vector towards the center of that, towards the potassic center. And if they find much higher grades, like 1.5% copper, that could be huge. And that could re-rate the company overnight much, much higher. And they have some other targets on their property, their Pegasus target, their Hook target, what they're calling the footwall zone at Leviathan, that all look like another potential porphyry. So I think there's going to be additional porphyry discoveries this year on their property. But yeah, so that's what the market is excited about. And yeah, it shows that what is currently, let's call it 500 million tons, has potential to be in the multi-billion tons. If these are porphyries, and if they can keep drilling those out and prove that there's more mineralization there, that's potentially economically extractable.
Last time on the show, you also talked about Altius Minerals, calling it a very high quality company with a phenomenal management team, but you thought the shares were a bit richly valued when they were trading up around $37 to $38 a share. Given the macro shifts and where commodity prices are sitting right now, what is your take on Altius today?
My views haven't changed a lot, but the revenues are really starting to pick up, especially after their acquisition of Lithium Royalty Corp. And the lithium prices have really picked up. Now, lithium, when they acquired the rest of Lithium Royalty Corp that they didn't already own, they this was a significant investment for them, and it it resulted in lithium being their biggest market segment. So Altius is a diversified royalty company. So they don't just have lithium, they also have renewable royalties and royalties on nickel and copper and gold and silver and iron ore and some other cobalt and maybe some others that are slipping my mind at the moment. So diversified across many commodities, very high quality company, really great management team, super long mine lives, very high quality assets, just a great company all around. Now, when they did that Lithium Royalty Corp transaction, the lithium price was still pretty low, but since then, and that transaction just closed, maybe I forget when the exact closing date was, but maybe 6 months ago, the lithium price has almost doubled since then. So the future revenues from those mines that are already online and are coming online and ramping up, there's an enormous difference from what it was supposed to be when they bought Lithium Royalty Corp. Now, I'm currently reevaluating my valuation on that, and yeah, I think it's a better buy, even though the stock is about the same price as the $37-$38 you mentioned. I do think it's a better buy today than I previously thought, because well, that lithium revenue is so strong and the copper prices are really strong. So their revenue is picking up a lot. And they also have their renewable royalty revenue that's picking up a lot because there's a lot of expansions there. But with Altius, it's all about your time frame, because if you have a 5 or 10 year time frame, Altius is going to see a tremendous amount of growth in their revenue. But if you have a 12-month time frame, I mean, you could easily see a 30% pullback in the stock sometime within the next year. So like, yeah, 10-year time frame, I think you're going to make a lot of money. 12-month time frame, I don't know. It's hit or miss.
You've also been a very vocal bull on Royal Gold for a number of months now, presenting a really compelling growth thesis. Looking at the charts lately, the stock price has shown some definite weakness, pulling back from its recent highs. Do you have a take on why the market is punishing this stock right now? And has anything changed in your underlying thesis for Royal Gold?
I mean, you look at any gold stock, pretty much all the royalty companies, all the producers, they're pretty much all well off from their highs. And it's largely because of the gold price. The gold price ran up to 5,500 and now it's bouncing around 4,500. And the gold price has been weak over the last few weeks, and that has caused a lot of that's caused a lowering of some of the multiples in the companies, which has brought down the stock prices. So with Royal and other high quality companies too, I think it's throwing the baby out with the bathwater. And no, my bull thesis has not changed. And if anything, I think it's gotten stronger. For example, one of the overhangs with the company was their 30% equity stake in Hod Maden, and they just renegotiated that and turned half of that into a royalty, and they also have an option to buy another royalty that came out of that deal, and then also they have a first right of refusal on another royalty on the same asset. So now they only own a 15% equity stake and have traded it for a top line royalty, which decreases the capex they have to spend during the mine build, and it basically just is higher quality cash flow because it comes right off the top line instead of being a percentage of profits after the mine is built. So no, my thesis hasn't changed at all. And one of the first lessons I learned as a kid when it comes to investing is you buy low and you sell high. And that's been ingrained in me from an early age. And I really like to buy low. So I've been an aggressive buyer of Royal Gold here and for the previous several months as well.
Now, what if we're pivoting to the other two giants in the royalty space, the gold and silver royalty space? If you had to deploy capital into one of them today, would it be Franco-Nevada or Wheaton Precious Metals?
Yeah, and I didn't mention in my Royal Gold answer that also part of my thesis is not just the growth they have, but also they're trading at a pretty significant discount to their peers, and not just the peers you just mentioned, Franco and Wheaton, but also smaller peers like Triple Flag Precious Metals and Osisko Gold, or what's now OR Royalties. Uh, they're trading at a discount to those companies on most metrics, even though Royal Gold is about 4 times the size. Now, if I had to choose between Franco-Nevada and Wheaton Precious Metals, look, you can't go wrong with either company. They're both great companies, but we're 10 years into this bull market. So I mean, if the gold price continues to fall, yeah, the stock prices are going to fall. But if you look at the long-term chart of those companies, they go from the bottom left to the top right because they have a great business model and they're run by great people. And well, they just have a business model that works, that grows their cash flow over time. And of course, there's some ups and downs along the way, but if you're a patient long-term holder over decades, it's very likely that you will do very well with either one of those stocks. Now, if I was forced to choose between them, I would probably choose Wheaton Precious Metals because they have a lot more growth that's already built in. Now, Franco-Nevada, the argument for them is, hey, they've been around longer, even though their stock chart doesn't go back as far because they were bought and spun out. So that created a gap in their stock chart. But they go back quite a few decades now, and they've made very good investments over that period of time. So they've really proven that they're able to recycle their cash flow into new great investments. And Wheaton has a great track record too, but their track record isn't as long. So also, Franco-Nevada has a bigger war chest because they have a stronger balance sheet because Wheaton just did a huge transaction with BHP buying a huge silver stream on Antamina. So Franco-Nevada has a much bigger war chest with money they can deploy, not only in the form of cash, but also in the form of their revolving credit facility. But Franco doesn't have as much growth built in. Now, they have Cobre Panama, which was shut down a few years ago by the Panamanian government, and that will probably come back online. And if it does, that does help their growth profile a lot. But aside from Cobre Panama, they only have about 15% growth over the next 5 years or so, whereas Wheaton Precious Metals has 50% growth. So Wheaton Precious Metals has way more growth, plus they're a very high quality company. And I think they're going to continue to buy more assets, and other companies love working with Wheaton Precious Metals because every time Wheaton Precious Metals announces that they're doing a stream with a mining company, well, then that is looked at very positively from the market because Wheaton has such a great history of deploying capital into these various projects. And if Wheaton's investing in it, well, then, hey, it must be a great project. And those stocks usually end up performing pretty well after Wheaton invests. But yeah, if I had to choose between the two, it'd be Wheaton. And the main reason is because of their growth, but also because on most metrics, they're a little bit cheaper. They're maybe 10, 15, 20% cheaper on most metrics.
Well, for those who want to dive deeper into everything you presented today, as well as some other stock ideas that you present, how can people sign up for Mining Stock Monkey? Tell us about that and how people can follow your work there.
Yeah, sure. So researching mining stocks is what I do full time. And if you like the way I think and want to know how I'm investing my own money, for anyone watching this, you can get 25% off your first year. However, this is limited to the first 15 subscribers who sign up or the first 48 hours, whichever comes first. And if you click on the link down in the comment or description below, and if the discount doesn't show after you click on that link, that means the offer is already sold out.
Great. Well, I'll put that link in the description. And if you're watching on YouTube, it will also be a pinned comment. Jordan, as always, greatly appreciate your insights and thank you for coming on the show.
Thanks for having me, Jesse. Happy to be back again.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.